Hey there, and welcome back to the channel. If you're in your 60s or approaching this milestone decade, today's video is specifically crafted for you. We're diving deep into a topic that affects millions of Americans every single year: when to begin claiming your Social Security retirement benefits. Now, conventional wisdom often tells us to delay benefits as long as possible, ideally until age 70, to maximize those monthly payments. And while that strategy works wonderfully for some individuals, it's definitely not the right path for everyone. The reality is far more nuanced than a simple one-size-fits-all recommendation. Today, I'm bringing you 10 compelling reasons why filing for Social Security benefits in your 60s might actually be the smartest financial decision you can make. Whether you're turning 60, 62, 65, or anywhere in between, this information could potentially save you thousands of dollars and give you the peace of mind you deserve during your retirement years. Before we jump into these reasons, let me be crystal clear. I'm not suggesting that everyone should rush to claim benefits early. Every person's situation is wonderfully unique, with different health circumstances, financial needs, family dynamics, and retirement goals. What I am saying is that there are legitimate, well-researched reasons why claiming benefits in your 60s could be the absolute best choice for your specific situation. So grab your favorite beverage, get comfortable, and let's explore these 10 compelling reasons together. And if you find this information valuable, please consider hitting that like button and subscribing to the channel. It really helps us continue creating this type of content for you. All right, let's dive right in.
Reason number 2, involuntary job loss or inability to continue working. Life doesn't always follow our carefully laid plans, does it? Many people enter their 60s fully intending to continue working until age 65, 67, or even 70. But then reality intervenes in ways we never anticipated. Perhaps your employer undergoes restructuring and you find yourself unexpectedly laid off in your early 60s. Maybe you've developed physical limitations that make your current job impossible to continue. Or perhaps you've been forced into an early retirement situation due to company downsizing. Whatever the specific circumstances, being unable to work while not yet ready financially for full retirement is an incredibly stressful position. According to recent research data, approximately 1 out of every 2 American workers over age 50 performs physically demanding labor. Slightly more than half report working in conditions that are hazardous or pose health risks. For these hard-working individuals, continuing employment into their late 60s simply isn't a realistic or safe option. Consider someone who has worked construction, roofing, or manufacturing for their entire career. By age 62, their body might be telling them in no uncertain terms that it's time to stop. Waiting 8 more years until age 70 simply isn't feasible when your physical health is deteriorating from years of demanding work. In situations like these, Social Security benefits can serve as a crucial financial lifeline. Yes, you'll receive reduced monthly payments, but having any income is infinitely better than having no income at all while you're unable to work. The reduced benefit might be exactly what you need to cover essential expenses like housing, utilities, food, and health care until you can access other retirement resources or qualify for additional assistance programs. Furthermore, if you're temporarily unemployed but expect to potentially return to the workforce, you need to consider Social Security's earnings test carefully. For 2025, if you're under your full retirement age, you can earn up to $23,400 annually without affecting your Social Security payments. Beyond that threshold, the Social Security Administration withholds $1 in benefits for every $2 you earn above the limit. However, if your unemployment appears to be permanent, claiming benefits early makes considerably more sense than draining your emergency savings or accumulating high-interest debt.
Reason number 3, need for immediate supplemental income. Let's talk honestly about money and living expenses, because this is a reality affecting millions of seniors across America today. The cost of living continues climbing year after year, and many Americans reaching their 60s discovered their existing income sources simply aren't sufficient to maintain their desired standard of living. Maybe your retirement savings didn't grow as much as you'd hoped. Perhaps unexpected expenses have depleted your nest egg more than anticipated. Or maybe inflation is eroding your purchasing power faster than your income can keep pace. Recent 2025 cost of living adjustment data reveals an uncomfortable truth. The Social Security COLA increase of 2.5% adds only about $50 to the average monthly benefit check. Meanwhile, essential expenses, housing costs, healthcare, groceries, utilities are increasing at rates that far outpace that modest adjustment. For many seniors, this creates a genuine financial squeeze that makes claiming benefits earlier extremely appealing. Historical data from the Great Recession period illustrates this point vividly. During 2008 and 2009, nearly 36% of eligible men and 39% of eligible women started claiming their Social Security benefits at age 62 for one fundamental reason: they needed money to pay their bills. Recent Social Security Administration data from 2024 shows that approximately 31% of eligible individuals still claim benefits at the earliest possible age. But here's something important to understand. Needing supplemental income isn't just about covering basic necessities, though that's certainly crucial. Sometimes retirees want additional funds for purposes that enhance their quality of life: traveling to visit grandchildren, pursuing hobbies and passions they've delayed for decades, helping family members through difficult times, or simply enjoying the fruits of their lifetime of labor. There's absolutely nothing wrong with deciding you want to enjoy your Social Security benefits while you're young enough and healthy enough to truly appreciate them. If waiting until age 70 means having more money but fewer years and less physical capability to enjoy it, claiming earlier might be the superior choice for your personal happiness and life satisfaction. Remember, retirement isn't just about maximizing every single dollar on paper. It's about maximizing your life satisfaction, comfort, security, and enjoyment during the years you have ahead of you.
Reason number 4, strategic spousal benefit coordination. For married couples, the decision about when to claim Social Security becomes significantly more complex and requires careful strategic planning. But this complexity also creates opportunities for optimization that single individuals don't have access to. Here's the fundamental principle. One spouse claiming benefits early can sometimes maximize the overall household income, particularly when there's a substantial difference in each spouse's earnings history. Let me explain how this works with a practical scenario. Imagine a married couple where one partner earned considerably more throughout their career than the other. The higher-earning spouse might choose to delay claiming benefits all the way to age 70, allowing their benefit to grow by roughly 8% for every year they wait past their full retirement age. Meanwhile, the lower-earning spouse could begin claiming their own benefit at age 62. This strategy creates immediate household income from the lower-earning spouse's benefit while simultaneously allowing the higher-earning spouse's benefit to grow substantially. Then, when the higher earner eventually claims at age 70, the lower earning spouse can potentially switch to a spousal benefit if that amount exceeds their own retirement benefit. But the advantages extend even further. In the unfortunate event that the higher earning spouse passes away first, the surviving spouse becomes eligible for survivor benefits equal to the deceased spouse's full amount. If the higher-earning spouse had delayed until age 70, that survivor benefit will be significantly larger, providing important financial security for the remainder of the surviving spouse's life. There's another scenario worth considering. Perhaps your spouse worked very few years or didn't work outside the home at all, meaning they don't qualify for their own retirement benefit. In this case, if you claim your benefits in your early 60s, even though your personal benefit will be reduced, you'll simultaneously trigger spousal benefits for your partner.
This creates two income streams when your household urgently needs them. According to recent survey data, about 71% of Americans between ages 25 and 66 say that maximizing their retirement income is very important to their benefit claiming decision. For married couples, coordinating your claiming strategies thoughtfully can help you achieve exactly that objective. Working with a qualified financial advisor who specializes in Social Security planning can help you model various scenarios and determine which combination of claiming ages will likely produce the highest total lifetime benefits for your household circumstances.
Reason number 5. Survivor benefits for widows and widowers. This reason specifically applies to individuals who have lost a spouse, and it represents one of the most underutilized but potentially valuable Social Security claiming strategies available. If your deceased spouse qualified for Social Security retirement benefits, you may be eligible to receive survivor benefits as early as age 60. This is actually 2 years earlier than you can claim regular retirement benefits based on your own work record. The strategic advantage here lies in understanding that you can claim one type of benefit first, then switch to the other later if it results in a higher payment. Here's how this strategy typically works. Let's say you're a widow or widower age 60, and you're eligible for both survivor benefits based on your deceased spouse's earnings record and retirement benefits based on your own work history. You can claim the survivor benefit beginning at age 60, providing you with essential income during your early 60s. This allows your own retirement benefit to continue growing until age 70, at which point it reaches its maximum value. If your personal retirement benefit at age 70 will exceed the survivor benefit amount, you can then switch to claiming your own retirement benefit. Alternatively, if the survivor benefit is higher, you can continue receiving that benefit for life. This flexibility is extraordinarily valuable because it allows you to generate income when you need it during your early 60s without permanently reducing your maximum potential benefit. You're essentially using one benefit stream to support yourself while allowing the other to grow to its largest possible amount. Many widows and widowers don't realize they have this option, and they end up claiming whichever benefit they hear about first, potentially costing themselves thousands of dollars over their retirement years. Taking time to understand your full range of options and calculating which claiming sequence produces the optimal outcome is absolutely worth the effort. Additionally, your survivor benefit amount can depend on the age at which your spouse claimed their own benefits. If your spouse had delayed claiming until age 70 before passing away, your survivor benefit will be based on that larger amount, providing you with greater financial security. If you're in this situation, I strongly recommend speaking with a Social Security representative or a financial advisor specializing in Social Security planning to ensure you're maximizing your total lifetime benefits.
Reason number 6. Limited retirement savings and investment assets. Let's address an uncomfortable financial reality that affects millions of Americans: inadequate retirement savings. Despite everyone's best intentions and efforts, many people reach their 60s without substantial retirement nest eggs. Perhaps you experienced job losses during critical saving years. Maybe you faced major medical expenses that depleted your accounts. You might have gone through a divorce that divided your assets. Or perhaps you needed to financially support family members, leaving less available for your own retirement savings. Whatever the reasons, if you're entering your 60s with limited 401k balances, modest IRA accounts, or minimal other investment assets, this significantly impacts your Social Security claiming strategy. Here's why. When you have limited retirement savings, you face a genuine risk of completely exhausting those funds during your later retirement years. If your savings run out when you're 75 or 80 years old, you'll be depending almost entirely on Social Security for your income. In this scenario, claiming a larger Social Security benefit becomes more valuable than preserving a small investment portfolio that might not last anyway.
Financial researchers have noted that delaying Social Security benefits is probably the right strategy for workers who haven't saved adequately on their own, because that larger monthly check becomes increasingly important when it's your primary or only income source in advanced age. However, there's a counterpoint to consider. If your limited savings mean you can't afford to live comfortably during your early 60s without Social Security income, then claiming earlier makes perfect sense. Using your Social Security benefits to cover living expenses allows your investment accounts more time to potentially grow before you need to access them. Let me illustrate with an example. Suppose you have $100,000 in retirement savings and your living expenses are $3,500 monthly. If you don't claim Social Security until age 70, you'll need to withdraw approximately $42,000 annually from your savings to cover expenses. At that withdrawal rate, your savings will be depleted in less than 3 years, leaving you with no cushion for emergencies. Alternatively, if you claim Social Security at age 62, even with reduced benefits of perhaps $1,800 monthly, you now only need to withdraw about $20,400 annually from your savings. This dramatically extends how long your savings will last and provides greater financial security. The key question becomes, would you rather have a larger Social Security check starting at age 70 with no savings remaining, or a smaller Social Security check starting at age 62 with some savings intact? For many people with limited assets, the second option provides better overall security.
Reason number 7. Desire for peace of mind and reducing financial anxiety. Sometimes the most important factors in financial decisions aren't purely mathematical. They're psychological and emotional, and that's perfectly valid and reasonable. There's genuine psychological value in knowing you have guaranteed income coming in each month. Social Security benefits provide something increasingly rare in modern retirement planning, a lifetime annuity that you can never outlive, never lose in a market crash, and that increases with inflation through cost of living adjustments. Research into Social Security claiming behavior reveals fascinating insights about human psychology. Many people feel a strong sense of ownership over their Social Security benefits after paying into the system for their entire working lives. They've watched those FICA taxes come out of every single paycheck for decades. Now that they're eligible to receive benefits, they understandably want to start collecting what they've earned. There's also a very human concern about longevity and the uncertainty of life itself. While we can look at statistical averages and life expectancy tables, we cannot predict individual futures with certainty. Many people have witnessed friends, family members, or colleagues pass away in their 60s or early 70s before ever collecting a single Social Security check, despite working and contributing their entire lives. This creates understandable anxiety. What if I wait until 70 and never get to enjoy my benefits? This isn't irrational thinking. It's a legitimate concern about the unpredictability of life and the desire to actually receive benefits while you're alive and healthy enough to enjoy them. Additionally, there's considerable uncertainty surrounding Social Security's long-term financial stability. While the program isn't going to disappear, many people worry about potential future changes to benefits, eligibility ages, or taxation rules. Some individuals decide that claiming benefits earlier provides certainty. They know exactly what they'll receive, and they're guaranteed to receive at least some benefits, regardless of what policy changes might occur in the future. For many people, especially those who have experienced financial hardship or insecurity earlier in life, the psychological comfort of having that guaranteed monthly income starting in their early 60s is worth more than the mathematical difference in lifetime benefits. Sleep well at night matters. Reducing anxiety and financial stress matters. Quality of life matters.
If claiming benefits in your early 60s gives you significant peace of mind and allows you to enjoy your retirement years with less financial worry, that's a perfectly legitimate reason to claim. Your mental and emotional well-being is an important component of a successful retirement, not something to dismiss or minimize.
Reason number 8. Planning to work part-time or pursue encore careers. Here's an interesting situation that doesn't get discussed as frequently as it should. Many people in their 60s aren't planning traditional retirements where they completely stop working. Instead, they're transitioning to part-time work, consulting arrangements, or entirely new encore careers that they find personally fulfilling. If you're planning to continue generating some earned income during your 60s, the Social Security earnings test becomes an important consideration, but it shouldn't necessarily discourage you from claiming benefits. For 2025, here's how the earnings test works. If you're under your full retirement age for the entire year, you can earn up to $23,400 without any impact on your Social Security benefits. If you earn more than this threshold, Social Security will withhold $1 in benefits for every $2 you earn above the limit. In the year you reach your full retirement age, the rules become more generous. The earnings limit increases to $62,160, and only $1 is withheld for every $3 you earn above this higher threshold. Importantly, these withheld amounts aren't permanently lost. Social Security recalculates your benefit when you reach full retirement age to account for the months when benefits were withheld. Now, here's why this might still make sense. Suppose you're 62 and want to work part-time earning $25,000 annually. You'd be $1,600 over the limit, meaning $800 in annual benefits would be withheld, about $67 per month. If your monthly benefit is $1,800, you'd still receive $1,733 monthly. Meanwhile, you're also earning your $25,000 in wages, giving you total income of around $45,800 annually. Compare this to not claiming Social Security and living only on your $25,000 in wages. Furthermore, continuing to work in your 60s can actually increase your future benefits. Social Security benefits are calculated based on your highest 35 years of earnings. If you're earning more in your 60s than you did in some of your earlier working years, those higher earnings will replace the lower years in your calculation, potentially increasing your benefit amount. For many people, the combination of reduced Social Security benefits plus part-time earnings provides more total income than working full-time without claiming benefits. Plus, you get the lifestyle benefits of working less while still maintaining income security. Additionally, if you're starting a business, consulting, or pursuing work you're passionate about, having Social Security income provides a financial foundation that reduces the pressure on your new venture to immediately generate substantial income.
Reason number 9, maximizing lifetime benefit collection based on break-even analysis. Now let's talk about some actual numbers and the concept of break-even age. This is where the mathematics of Social Security claiming gets really interesting. The break-even age is the point at which delaying benefits to receive larger monthly payments results in more total lifetime benefits than claiming earlier with smaller payments. This calculation requires comparing the cumulative benefits you'd receive under different claiming scenarios. Here's a straightforward example. Imagine your full retirement age benefit would be $2,000 monthly at age 67. If you claim at age 62, you'll receive approximately $1,400 monthly. If you wait until age 70, you'll receive approximately $2,480 monthly. By claiming at 62, you start collecting immediately and will have received $168,000 in total benefits by the time you reach age 70. 96 months times $1,400 is $134,400, adjusted for COLAs. If you waited until 70 to claim, you start with $0 in collected benefits.
The break-even point is reached when the cumulative benefits of waiting equal and then exceed the cumulative benefits of claiming early. For most people, this break-even point falls somewhere between ages 78 and 84, depending on their specific benefit amounts and the applicable cost of living adjustments during those years. If you don't expect to live past your late 70s or early 80s, claiming at age 62 or shortly thereafter results in higher lifetime benefits. But here's what many people don't consider. Break-even analysis assumes you have no alternative investment opportunities. However, if you have retirement savings you're living on while delaying Social Security, you need to account for what you could earn by claiming early and investing those benefit dollars. Suppose you claim benefits at 62 and invest them reasonably conservatively, earning perhaps 4 to 5% annually. That growth could significantly shift the break-even calculation in favor of earlier claiming, particularly if you're skilled at managing investments. Additionally, having access to money earlier gives you flexibility in how you use it, paying off debts, making home improvements, helping family members, taking trips, or making other purchases that improve your quality of life during your younger, more active retirement years. The mathematical reality is this. If you have reasons to believe your lifespan might be shorter than average, claiming benefits in your early 60s often produces higher total lifetime benefits. Even if you live an average lifespan, the difference in total lifetime benefits between claiming at 62 versus 70 might be smaller than you expect, especially when you factor in the time value of money and investment opportunities.
Reason number 10. Preserving other retirement assets for legacy and estate planning. Our final reason involves thinking about your complete financial picture, particularly if leaving a financial legacy for your heirs is important to you. Social Security benefits cannot be inherited. When you pass away, your monthly payments stop, except for potential survivor benefits for an eligible spouse. Your IRA accounts, 401k plans, investment portfolios, real estate, and other assets, however, can be passed to your beneficiaries and heirs. This creates an interesting strategic opportunity. By claiming Social Security benefits in your 60s and using that income to cover living expenses, you can preserve more of your inheritable assets. Instead of drawing down your IRA or selling investments to pay bills, those assets remain intact and continue growing for your children, grandchildren, or other beneficiaries. Let's consider a practical scenario. You're 65 years old with $500,000 in retirement accounts. Your annual expenses are $50,000. If you don't claim Social Security until age 70, you'll need to withdraw $250,000 from your retirement accounts over those 5 years to cover expenses. Your remaining account balance at age 70 would be approximately $250,000, potentially more or less depending on market performance. Alternatively, if you claim Social Security at 65, even with slightly reduced benefits, providing perhaps $30,000 annually, you only need to withdraw $20,000 annually from your accounts, just $100,000 over 5 years. This strategy preserves an additional $150,000 in your accounts that can be left to your heirs. Furthermore, those preserved assets continue having the potential to grow. If your $500,000 portfolio earns an average return of 6% annually, the extra $150,000 you preserve could grow substantially over your remaining retirement years, significantly increasing what you ultimately leave to your beneficiaries. There's also a tax planning dimension to consider. Social Security benefits receive favorable tax treatment, with many recipients paying little or no federal income tax on their benefits. Meanwhile, traditional IRA and 401k withdrawals are fully taxable as ordinary income. By using Social Security income instead of retirement account withdrawals, you might reduce your overall tax burden during retirement, preserving more after-tax wealth. This strategy is particularly valuable if you have more than adequate retirement assets to support your lifestyle, and your primary goal shifts from maximizing your own retirement income to maximizing your estate for your heirs. You're essentially converting non-inheritable Social Security benefits into inheritable investment assets. Additionally, some people prefer this approach because it provides flexibility. If unexpected expenses arise or circumstances change, you still have substantial retirement assets available. Whereas if you had spent down your accounts while delaying Social Security, those assets would be gone and unavailable. So there you have it. 10 compelling, well-researched reasons why filing for Social Security benefits during your 60s might be the smartest financial decision for your specific circumstances. Let's quickly recap what we've covered today. Health concerns and family longevity history that suggest a potentially shorter retirement period. Involuntary job loss or physical inability to continue working. Need for immediate supplemental income to maintain your desired lifestyle. Strategic spousal benefit coordination to maximize household income. Survivor benefit strategies for widows and widowers. Limited retirement savings that makes current income more valuable. The psychological value of peace of mind and reduced financial anxiety. Plans to continue part-time work or pursue encore career opportunities. Break-even analysis suggesting higher lifetime benefits from earlier claiming. Preserving inheritable assets for legacy and estate planning purposes. Now here's what I want you to understand clearly. I'm not advocating that everyone should automatically claim benefits in their early 60s. Far from it. For many individuals, particularly those in excellent health with family longevity, substantial retirement savings, no urgent need for income, and the ability to continue working, delaying benefits until age 70 absolutely makes the most sense. The point of today's video is to challenge the oversimplified narrative that everyone should wait as long as possible. The reality is significantly more nuanced than that. Your optimal claiming age depends on your unique combination of health, finances, family situation, goals, and values. There is no universal, correct answer that applies to everyone.
What I strongly encourage you to do is this. Take time to carefully evaluate your own situation against these 10 factors. Consider which ones apply to you. Run the numbers for your specific benefit amounts. Think honestly about your health and your goals for retirement. Consider your family's needs and your legacy wishes. If appropriate, consult with a qualified financial advisor who specializes in Social Security planning. These professionals have access to sophisticated software that can model dozens of scenarios and help you understand the potential long-term implications of different claiming strategies. A few $100s invested in professional guidance could literally result in tens of thousands of dollars in optimized lifetime benefits. You can also use the Social Security Administration's online calculators and tools, which provide personalized estimates based on your actual earnings history. Creating a My Social Security account at ssa.gov gives you access to your projected benefit amounts at different claiming ages, helping you make more informed decisions. Remember, this is one of the most significant financial decisions you'll make in your life. Your Social Security claiming age will impact your monthly income for the rest of your retirement, potentially 20, 30, or even 40 years. It deserves careful thought, thorough analysis, and informed decision-making. Whatever you ultimately decide, make sure it's a decision based on your circumstances, your needs, your health, and your goals, not based on oversimplified rules, fear, or what worked for someone else in a completely different situation. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe to our channel for more retirement planning and Social Security strategies. Drop a comment below sharing your thoughts or questions about claiming strategies. I love hearing from you, and your questions often inspire future videos. Thank you so much for watching, and I wish you all the very best in your retirement planning journey. Remember, you've worked hard your entire life for these benefits. Make sure you claim them in a way that truly serves your best interests. Until next time, take care and happy planning.
The information provided in this video is for educational and informational purposes only and should not be construed as financial, legal, or tax advice. Social Security rules and regulations are complex and subject to change. Individual circumstances vary widely. Before making any decisions regarding Social Security benefits, please consult with qualified financial advisors, tax professionals, and/or Social Security Administration representatives who can provide guidance tailored to your specific situation. The creator of this content is not responsible for any financial decisions made based on this information.